first chapter we'll cover is accounting for long-term liabilities. First thing we'll take a look at what are general long-term liabilities, as well as take a look at the two types of tax-supported bonds. We'll take a look at briefly cover accounting for general long-term liabilities, look at a debt service fund, and accounting for a debt service fund. And then we will cover a short example on accounting for expenditures in a debt service fund. First, we'll take a look at what are general long-term liabilities. These are debt and other long-term liabilities that come about or arise from the activities of governmental funds, and that they're not accounted for as liabilities of a proprietary or fiduciary fund. Tax-supported bonds are general long-term liabilities, long-term notes, capital lease obligations, unfunded pension obligations, long-term portion of judgments, as well as pollution remediation obligations, among other things. GASB Statement 49 is what brought about the pollution remediation obligations. These are liabilities that arise from hazardous waste or other existing pollution that the governmental entity is responsible for the cleanup for. Now we'll talk about the two main types of tax-supported bonds. First, term bonds. These are where principal matures in one lump sum at the end of the bond term, sort of like a balloon type maturity that you see with mortgages sometimes. They're not used as much as the serial bonds are, and the reason are the disadvantages are they require a sinking fund, and therefore investment management and accounting is much more complex. The sinking fund is where the entity has to set aside funds for repayment of the debt, but it helps them maintain their liquidity. Serial bonds are the more frequently used type of bonds. Their principal matures in annual installments. There's no sinking fund that's needed, again, because you're paying the debt as you go. And there's four types. There's a regular, where the amount of principal redemption is the same each period. There's a deferred, where you basically take at least a year off from repayment at the start of the term. There's an annuity type where the principal amount gradually increases throughout the term of the bond, kind of like your mortgage does. And there are irregular debt service payments. There's an irregular type where it doesn't fit into those other three categories. The one we're going to talk about the most in the class are the regular serial bonds. Now we'll cover how to account for general long-term liabilities. A debt service fund should be used when you're accounting for the principal and interest payment for general long-term liabilities. And again, we're only talking about the current portion, the current principal, current interest payments. The long-term liabilities themselves are not reported in the governmental fund. They are reported in the general long-term in the governmental activities column of the government-wide statement of net assets, because remember, the governmental funds have a current focus. So the debt service fund is only used for principal and interest payments that are current. Again, just to review, debt service funds account for financial resources that are restricted, committed, or assigned to the expenditure for principal and interest of all general long-term debt in the current term. The debt service fund doesn't account for the long-term debt itself. That's done in the governmental activities section of the government-wide financial statement. And how does a debt service raise money to make these payments? There are several sources. One, a debt service fund can levy taxes directly. Two, taxes can be levied by the general fund and then transferred to the debt service fund. Or the debt service fund can have special assessments to raise money for debt service. Again, just to wrap up here, Debt service funds have a current resources measurement focus and thus use modified accrual basis of accounting. The expenditures and interest are only recognized in the period when they're legally due. So that means that there's not accruals made at the end of a period. Say if payment is due on January 1st, 2011, you don't accrue for the interest due on December 31st, 2010. However, if the interest was due on December 31st, 2010 and it wasn't paid, then you do have to recognize a interest expenditure because you're late. So it's already legally due. And just keep that answer in mind for one of your test questions. That's one that's tripped up people in the past. Budgetary accounting is typically used. But encumbrance accounting is not, because you're not dealing with purchase orders and things like that. The required financial statements for debt service funds include a balance sheet and statement of revenues, expenditures, changes in fund balance. In addition to those two, though, you also have to have a note disclosure that show all future debt service requirements for all outstanding debt. All right, and finally, we'll go over a quick example before a more detailed problem that you'll find later in the learning module. If you assume that $100,000 of 6% bonds are issued on January 1st, 2011 to pay interest semi-annually on January 1st and July 1st. The fiscal year ends 12/31. So what amount of expenditures will be recognized in fiscal 2011? Well, the answer to this is, first you need to get what the semi-annual coupon interest payment's going to be. And for that, you just take the $100,000 face value, multiply by the 6% coupon rate, then multiply that by 1/2, since that coupon rate is an annual rate, to get the $3,000 semi-annual interest payment. The deal is, though, because you're not accruing any expenses in a modified accrual system for a governmental fund, the debt service fund, you're only recognizing the June 30th interest payment, or $3,000, during fiscal year 2011 as an expenditure. The January 1st, 2011 expenditure coupon payment will be where you recognize the second $3,000 payment, because that is when it's legally due. And now, later on in the module, you'll cover some more extensive problems.